This is not financial advice, educational content only. Headlines today are about earnings beats. Company X reported adjusted EPS of 2.45, beating estimates by 25 cents. The thing that quietly got removed from that number is stock-based compensation. It could be $100 million. It could be $2 billion. In a lot of technology and high-growth companies, SBC represents one of the largest operating costs in the entire business. The argument for stripping it out is that it's not a cash charge. The argument against is that it's real dilution, real value transferred from existing shareholders to employees. Let's look at what the 10K actually shows, because this is a question about accounting presentation choices, and the disclosure is there if you know where to find it. Every earnings release from a technology or growth company comes with two income statements. The GAAP one, required by the SEC, which includes stock-based compensation expense, and the Non-GAAP one, which the company itself constructs and which almost universally strips SBC out. This is legal. Under Regulation G, if you present a non-GAAP metric, you're required to reconcile it back to the nearest GAAP equivalent. Companies comply. The reconciliation table is in the earnings release. But most press coverage lives at the top, where the adjusted number sits. The practical effect is that most market participants form their initial impression of earnings quality from a number that has removed what is, in many cases, a 9 or 10-figure cost. The charge itself is real. Under ASC 7018, the FASB standard governing equity compensation, SBC is recognized as an expense over the vesting period of the award, measured at the grant date fair value. It flows through operating income. It reduces GAAP net income. Stripping it out to produce an adjusted figure is an active choice, not a correction. The 10K is where you get the full picture, and SBC appears in three places. First, the income statement. SBC is usually embedded across multiple expense lines: cost of revenue, research and development, sales and marketing. Sometimes companies break it out as a standalone footnote disclosure. Sometimes you have to add across the categories yourself. Second, the cash flow statement. Because SBC is a non-cash charge, it shows up as an add back to net income in the operating activities reconciliation. Cash from operations looks better than GAAP net income partly for this reason. The charge is real, but it didn't consume cash in the period it was recognized. That's the source of the "it's not cash" argument. Third, and most important, the equity awards note, usually labeled something like Note What 12A stock-based compensation or Note 9A equity plans, though the exact label varies by company. This note discloses the total unrecognized compensation cost associated with unvested awards and the weighted average period over which that cost will be recognized. That unrecognized figure is a forward-looking charge already committed. Future GAAP income will absorb it regardless of whether new grants are issued. It's a material forward obligation. Most earnings discussions don't touch it. When a company grants restricted stock units to employees, those RSUs convert to shares upon vesting. The share count goes up. How much? Two numbers matter: basic shares, what's actually outstanding today, and diluted shares, which is basic plus all the shares that would exist if every the money option were exercised and every RSU vested. You'll find both in the 10K. The gap between diluted and basic shares is your dilution overhang. For a mature large cap with measured equity compensation, this spread might run 1 to 3% of basic shares. For an earlier stage technology company that relies heavily on equity to retain talent, I've seen that number consistently sit above 10%, and 10% dilution on a $50 billion market cap company is $5 billion in value transfer from existing shareholders to employees. Measured at the current stock price, that's the economic cost of SBC as opposed to the accounting cost, which is locked in at grant date fair value. These two figures diverge significantly when the stock moves. The accounting method that determines diluted EPS under GAAP is the treasury stock method when computing the dilutive effect of options. You assume the exercise proceeds are used to repurchase shares at the average market price during the period, which reduces the net dilution. This doesn't apply to RSUs, which have no exercise price. For RSU-heavy compensation structures, which is most of the technology industry post-2010, the treasury stock adjustment is smaller, and the diluted share count is a more direct rate of overhang than it was in the stock option era. 3 specific items to find in the equity awards note. 1. The weighted average grant date fair value of RSUs granted during the year. This is the accounting cost per share at the time of grant. Compare it to the current stock price. If the stock has appreciated substantially since grants were made, the GAAP expense understates the economic cost. The employees are receiving something worth more than what's flowing through the income statement. If the stock has fallen, GAAP overstates it. 2. The shares available for future grants under the equity plan. Most companies authorize a pool of shares for compensation purposes, and the 10K will tell you how much headroom remains in that pool. This is a forward dilution indicator. A large available pool implies the company intends to continue issuing at current or higher rates. 3. The unrecognized compensation cost and the expected recognition period. Required disclosure under ASC 70-1050. If unrecognized cost is large relative to current annual SBC expense, the run rate is increasing. None of these numbers appear in the earnings press release. They're in the notes to consolidated financial statements. Here's how I think about it. That's my read. Weigh it as you see fit. The SBC is not a real expense because its not cash argument is mostly wrong. It is a real cost, paid in equity rather than cash, but equity has value and the transfer is real. The more defensible version of the add-back argument is SBC represents a financing choice, not an operating one, because the company is compensating in equity rather than cash, and you could imagine them paying higher cash salaries and separately issuing stock. In that framing, stripping SBC from operating metrics is similar in logic to stripping interest expense. It's about separating capital structure decisions from operating performance. I don't fully buy the analogy, but it's at least coherent. What I think is clearly wrong is treating non-GAAP margins as a stable proxy for the long-run economics of the business. If SBC grows with revenue, which it has in most high-growth technology companies over the past decade, the adjusted margins are not a floor. They're a ratio that holds only if the compensation structure stays fixed. That assumption has not held in periods of competition for technical talent. That's my read. Real tool for your next earnings season. Pull the equity awards note from the most recent 10K. Note 3 numbers: total annual SBC expense, unrecognized compensation cost, and diluted minus basic shares. Divide unrecognized by annual SBC to get the forward coverage ratio. If it's above 1, the expense line is growing. Divide diluted minus basic by basic for your dilution overhang percentage. Neither tells you whether the business is worth owning. Both tell you what you're paying for the talent. Next time you see an adjusted earnings headline, you'll know what was removed and where to find the disclosure. I'm Diane, back next briefing.